Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2, and I do like to share my lectures on YouTube for the public. And this is primarily for my Accounting 3110 class. That's the primary purpose. But someone by happenstance comes across these, I hope that you might find them useful. Today's lecture is around inventory. Additional issues. So it's really the second topic around inventory. Inventory is so complex, so important that in the McGraw-Hill textbook that I use, Spicer, Nelson, and Thomas, it covers 2 chapters. And I'm sure a lot of textbooks do that. So today's lecture is the second lecture around the additional issues, and I'm going to work problems today. And so that's actually, I think, a lot more fun. And maybe more interesting to listen to. And as I suggest on the lectures with problems, I would suggest that you pause the video when you see the problem, go work it yourself, restart the video and see how I worked it. And hopefully we get the same answer. And so with that, I'm gonna share my screen. Okay, so here's the first problem, and this is going to be the lower of cost of market, or lower of cost or net realizable value, depending on whether you're on their FIFO or LIFO. They are different. So with that, I'm going to let you I'll let you pause and go work it, and then when you come back and restart the video, I'll work it. All right, welcome back. If you pause the video, and let's get started here. Gotta move my face out of the way here, I think. There, okay. All right, so we've got 5 different products here. We have the cost, the replacement cost, the selling price, and then there is also some more information here. To sell the product, we've got to pay a sales commission of 10% of the price, and we've got to ship the product to the customer that is estimated at 5% of the cost. Okay, so let's just get started here. I'm going to label my products across the top here: A, B, C, D, and E. If you watched my lectures before, my handwriting is not the greatest, and not much I can do about that, I guess. So let's look at the cost is 40, 80 for product B, 40 for product C. Product D is $100, and product E is $20. Okay, so let's go do FIFO first, and that is the lower of cost or net realizable value. So we've got to go calculate the net realizable value, which is nothing more than the price minus the cost to sell. So let's pick up the prices. This is 60 for product A, 100 for product B, 80 for product C, 130 for product D, and $30 for product D. And we got to do minus commission, which is 10% of the price, right? And so the price is 60, and then 10% of that, 6. 10% of 100 is 10, 8. This is easy math so far. And then minus shipping, which is 5% of cost. So the cost, 5% of 40 is 2. 5% of 80 is $4. Again, 5% of 40 is 2 again. 5% of 100 is 5. 5% of 20 is $1. And so now we have enough information here. Price minus the cost to sell, and so we can understand our NRV. 60 minus the 8 cost, 52, 10 minus 14, 86. 80 minus 10, 70. 130 minus 18, 112. And then 30 minus 4, 26. So now, just a matter of comparison, lower of cost or net realizable value. Again, this is under FIFO or the average cost method. This is the method you use. And so we just pick the lowest, 40 versus 52, 40. 80 versus 86, 80. 40 versus 70, 40. 100 versus 12, 100. 20 versus 24, 20. And so in this case, in every circumstance, the cost is lower than the net realizable value. And that's what we include for our answer there. Let's go do LIFO then, which is the lower cost or market. What's the, we'll see here, this gets a little bit more complex. So the market is the replacement cost, and that's 35, 70, 55, 70, or 28. And now we got to go calculate the ceiling and the floor. Remember this, for lower cost of market, we have a ceiling and a floor, and that's only for LIFO and the retail method. You're required under those methods to use lower cost of market. You're not allowed to use lower cost or net realizable value. Just make it harder, for this course, unfortunately. So the ceiling is the NRV. Well, we've already calculated that. 52, 86, 70, 112, 24. And the floor is going to be the ceiling, the net realizable value, by minus a profit margin. So, and that's going to be 30%. And that's going to be of the price. The profit margin is calculated off the price. So we come back up here. Here's the prices that I used up here to calculate NRV earlier. So 30% of 60, 18, 30% of 100, minus 30, 30% of 80, minus 24, 30% of 130, 39, 30% of 26. So now I can calculate my NRV minus the profit margin, which is going to be my floor for this market price. So 52 minus 18, 34, 86 minus 30, 56, 70 minus 24, 46, 112 minus 39, 73, and 24 minus 6, 18. So now we have kind of, I'll just call it an adjusted market, if you will, because we're going to compare lower of cost to the market, but we have some parameters around the market. Eventually, we're going to compare cost to this adjusted market, but let's go look at the adjusted market. And so we're going to look, is our market higher than our floor? Yes. So we can, and it's lower than our ceiling. So boom, we're good. 35. 70 is also in the middle, higher than the floor and lower than the ceiling. So that becomes the adjusted market price. 55 is, lower than the ceiling and higher than the floor, 55. So we're good there. 70, it is lower than the floor. Can't go lower than the floor. So this time we pick up the 73. So, again, the market price has to be between 112 and 173. We cannot go lower than that. And then the 28, here, look at this. This is higher than the ceiling. We can't go higher than the ceiling. 24. Oh, I'm just checking my work here and I see that 30 minus 4 is 26. I had a problem here that my ceiling should have been 26. I know you guys are having fun now looking at me screw up here. All right. I just can't do, it was such hard math for me, 30 minus 3 minus 1. I couldn't get that right. That's pretty bad. Yeah, 26. And so now 28, still higher than 26. My ceiling has to be my adjusted market has to be the ceiling. Now, what's the lower of cost of market? Okay, 40 versus 35, 35. 70 versus 70, 70. 40 versus 55, 40. 100 versus 73, 73. 20 versus 26, 20. And if you're in my class, you have these spreadsheets. Let's just see available to you. Make sure we got it right. 35, 70, 40, 73, and 20. Okay. I can congratulate myself on such good work. So that's it for problem 1. Let's go to this. Get rid of that. I'll save that. And problem 2. All right. Again, same problem. We're trying to go get the lower of cost of net realizable value for FIFO and the lower of cost or market for LIFO. Let's get our products across the top here. We'll go up a little bit. All right. So what's the cost? This is what we're going to be comparing both of these to. And when we say cost, that's what we paid for it. That's the historical cost. That's sitting in our books right now. That's on the books. And so A is on the books for $800 per unit, B at $750, C at $1,000, D at $1,200, and E at $900. So this is what we'll be comparing to for both FIFO and LIFO. We'll do FIFO first, which is lower of cost or net realizable value. And so let's go calculate net realizable value, which starts with the price. And we have these over here in the third column, right here. Price is 1,000, 800, 950, 1,300, and 1,000. Minus commission. In this case, the commission is just 5% of the price. So 5% of 1,000 is 50. 5% of 800 is 40. 5% of 950, 47.50. 5% of 1,300, 65. 5% of 1,000, 50. Minus shipping. These are all the costs we're going to incur in the future to sell this product. So that's what's going to be the net realizable cash price minus the cost to be able to sell it. And the shipping is listed at 10% of cost. So you have to be really careful that you don't pick up the wrong percent of price there for that. So 10% of the cost, 80. 10% of 750, 75. 10% of 1,000, 100. That's 120, 10% here. And 10% here, 90. So now we've calculated net realizable value. 1,000 minus 130, 870. 800 minus 115, 685. 950 minus 147.50, 802.50. 1,300 minus 185, 1,115, and 1,000 minus 140, 860. So now it's just logic. Compare. Lower of cost or NRV. Which is lower? Cost is lower, 800. Which is lower? NRV is lower, 685. NRV is lower, 802.50. 1,115 is lower than 1,200. And 860 is lower than 900. And so therefore, we've taken care of the first part of this problem, which was the LIFO, the FIFO, I mean. Now let's go to LIFO, which is lower of cost or market. They should say adjusted market, because we're going to have a ceiling for that market price and a floor. What is the market? Which is the replacement cost, is what we consider the market. 850, and I'm pulling this right off the spreadsheet right here in the second column. 900, 1,100, and 850. Let's go get ceiling in the floor. Ceiling is the NRV, which we've already calculated, 870, 685, 802.50, 1,115, and 860. And then the floor is the NRV minus the profit margin. How much is the profit margin? We see 20%. So 20% of the price. 20% of 1,000 is 200. 20% of 800 is 160. 20% of 950 is 190. 20% of 1,300 is 260. 20% of 1,000, 200. So now we have the floor. So 525. That's just 855. 660. So now let's do adjusted market. And so what we're looking for here, where does market stand? Is it higher than the ceiling? Then we have to take the ceiling. If it's lower than the floor, we got to take the floor. If it's in the middle, we pick the market. So we can see, hey, that's in the middle between 670 and 870. So we just can pick up the market as the adjusted market. 450, lower than the floor. Can't go lower than the floor. 525. 900, higher than the ceiling. 802.50, we pick up the ceiling. And then here, this is in the middle. This is just slightly lower than the ceiling. We can pick that up, and it's higher than the floor. And 850, again, lower than the ceiling, but higher than the floor. 850. All right, now lower of cost of market. And we compare this number here to our cost, lower of cost or market. 800 is lower than 850. 800. 525 is lower than the cost, 750. 802.50 is lower than the cost, 1100 lower than the cost, and then 850. So this is just pure logic here, and that's what we'll have to go do our journal entries around. Let's see, again, if I got that right. 800, 525, 802.50, 1100, 850. Applause. You know? All right. Next problem. Number 3. Okay, so we're switching gears here. Now we're going to go do the gross profit method and our next problem. And so in the gross profit method, we're going to have to estimate the ending inventory. Why would we ever have to do that? Well, it's most likely because it's not there anymore. And in fact, this problem, inventory was destroyed by a fire. It's gone. We can't count it. So we've got to find a way to estimate that, maybe for our insurance company, maybe for whatever kind of financial statements we're trying to create, and say, hey, what was lost by fire. So to do that, guess what? We use the gross profit method. Okay. So beginning inventory. And we'll do this in thousands to make it easy. 1900. And I'm trying to calculate available for sale here. Purchases, 5,800,000. And then freight in. Well, that's part of, that is, as we know from the chapter, that's an inventory cost. What we could call, we say a lot of times in business, it can be capitalized, means I don't expense it, I record it in the inventory as an asset. So this goes into part of our asset. So available for sale, which we know from our records, 1900 versus 5800, that's 6777, 8,100,000, because this is in thousands. Now, let's go estimate the cost of goods sold. How will we do that? Sales equal 8,200. And we know that our normal gross profit ratio means, and what's gross profit? That's, just think about this for a minute. It's sales minus cost of goods sold. That's what we're trying to estimate, equals, X, and X divided by that is 20%. So, the cost of goods sold is going to equal 80% of that. I'll prove it out to you in a minute. So 80% of 8,200 is 6,560,000. Let's go see if that was right. So we looked at the financial statement of 8,200 minus 6,560. Our gross profit would have been 1,640,000. %. We take 1,640,000. So this is really, 1 minus the gross profit. That's how I get to that 80%. So I know this from my records throughout the year. I was selling stuff at a 20% gross profit, and then the inventory is gone. And I'm trying to guesstimate how much is out there. Well, I can estimate my cost of goods sold. Well, if I take my available for sale minus the cost of goods sold, 6560, that's got to be equal, that's got to equal my ending inventory. What is that? 8100 minus 6560, 1,540,000. Remember, the normal formula we do is available for sale, minus ending inventory equals cost of goods sold. So we just reverse those two, and algebraically it still works, right? So this is, we use very, very simple kind of algebra in accounting. And so there's my ending inventory, 1,540,000. Okay, that's it for the gross profit method. Hopefully you get that right. And hopefully you guys are pausing here, after you see the problem there and you try to work it. Okay, now we're switching gears and to what we call the retail method. Now, guess what? A lot of high power retailers use this method. Oh, you know what? I'm going to do another gross profit. I think I had another one here. I didn't realize I had a fourth one. Problem number 4. So let's do another gross profit. I think it'll be boring for a lot of you because this one is so easy, but it gives you another chance to go work it though. Make this a little bigger. So right now you can go work this problem. It's a different gross profit margin, and so inventory destroyed by fire again. And so please go, try to work this. Okay, welcome back. Let's take a look at this again. And so let's go calculate our available for sale. Beginning inventory. Equals 500,000. I'm going to do this in thousands. Plus purchases, 4,600,000. Plus freight in, 400,000. It's the same as the last problem. So available for sale equals, okay, 500,000. Now, normally what we would do is go count the inventory minus ending inventory equals cost of goods sold. Cannot count it. It's gone. It's destroyed by fire. So we're going to go estimate it, guesstimate it, if you will, educated guess at least. We're going to go calculate what we think cost of goods sold would be from the gross margin. So cost of goods sold. So we know that sales were 7,500,000, and gross profit percent equals 30%. Parentheses there. And so cost of goods sold equal 7,500 times 1 minus 30% or 70% equals 7,500 times 70%. $5,250,000, and that represents, what our normal cost of goods sold would be on, using the gross profit percent, based on the 7.5 million of sales. So now all we need to do to find ending inventory is subtract available for sale minus our cost of goods sold, 5,250, and we have ending inventory. And oh, you know what? I did not put the visualizer on as I worked that whole problem. Oh, I'm sorry, guys. So let me just, go back and do this again. So I put my beginning inventory plus my purchases plus freight in, and I got available for sale. I calculated my cost of goods sold, 7,500, using my 30% gross profit. So therefore I knew cost of goods sold equals the 7,500 in sales times 1 minus the 30%. Because gross profit equals sales minus the cost of goods sold, and that answer divided by by sales is our gross profit percent. So I know that cost of goods sold would equal 70% of that, or 5,250. Now that I know my available for sale minus my cost of goods sold, I can have an estimate for ending inventory. All right, guys. Yeah, I'll make sure. I do that in class sometimes, but I have people yelling at me. That doesn't work here. No one's yelling at me, just by myself here. And here we got number 5. Okay, so now we're going to move in. I'm going to put my visualize up there right now before I forget it. Okay, and again, I would suggest that you pause the video and try to work this problem. This is the, now we're going to use the conventional retail method. And we're going to, we know the cost of purchase, the cost of inventory, the cost of our freight in. And we also know, because we're a retailer, we're really good at this. We know the retail prices of what we purchase and, what our beginning inventory was. And we know markups and markdowns from our system, and we know how much we sold. And using that information, now we're going to go calculate our ending inventory. And by the way, our cost of goods sold. Now, this is real world stuff here. This is how, large companies, many large companies, retailers, this is how they calculate their ending inventory for their financial statements. So you guys pause, go work this, and then come back. Okay, so now we're using the conventional retail method. In the conventional retail method, we include the markups when we calculate our cost of retail percentage, but we do not include the markdowns. That's the only difference. In the average cost method, we use both of those. And as a reminder, there's also a LIFO retail method, a dollar value LIFO retail method. I'm not holding my class responsible for those, but they are out there. And if you're watching this in the public forum, your professor may hold you accountable for it. Good luck with that. You can do it. Once you can do these two and see how I work it, you can go back and text and you can figure out the LIFO method relatively simply. I just didn't want to inundate my students with all the stuff that they're already inundated with in these last 2 inventory chapters. So let's get started here. So we're going to go have a cost column, and we're going to have a retail column. And so, same, kind of formula, beginning inventory. We're going to go calculate our available for sale, and then we're going to go calculate using that, calculate our cost of goods sold, and then our ending inventory at retail. So let's look at what we have here. So we know that the cost of this merchandising, it was 190,000, and at retail prices, it would have been 280,000 plus purchases, 600,000 it cost, and those purchases were 840,000 on the retail side, plus freight in. This is an inventory cost, 8,000. Well, trade-in has nothing to do with the retail prices of those goods. It's just something in accounting we count as cost. And so therefore, that is not on the retail side. And so in the conventional retail method, we use the markups on the retail side to help calculate to our cost of retail percentage. We do not use the markdowns to add 20,000 here. So let's go available for sale. We've got 190 plus 600 plus 8, 798,000. On the retail side, we've got 280 plus 840 plus 20, 1,140,000. Now we just take 798 divided by 1140, the cost to retail percent. Okay, 798 divided by 1140, 70%. Now let's go finish up on the retail side. We don't have any more information for the cost side, but the retail side, we know that this is our available for sale, and then we have our mark downs. Now notice how the problem works out. They don't tell you that that's a minus. You've got to know that. Mark up, up, mark down, down. So that's going to be a subtraction of 4,000. And we sold stuff, and we sold, let's see, 800,000. So we can now do ending inventory at retail, and that's 1140 minus 4 minus 800. I get to 336,000. So I know my ending inventory at retail. I don't keep it on the books at retail. I got to keep it on my books at cost. But guess what I know from actual data? My cost, my retail is 70%. So therefore, my inventory, and it is an estimate. So at cost is going to equal 70% times 336,000 equals to 70%, 235,200. How about cost of goods sold? Well, I got 798 available for sale minus 235,200, my cost of goods sold. $562,800. And so that's the conventional retail method. And then our last problem is going to be another retail inventory method, but it's going to use the average cost method. So now that we just worked that one, hopefully you could do that. You could try to work it on your own, pause your video, work this, and come back and see if you get the same answer that I do. Okay, let's start with our cost versus our retail columns. And we're going to go calculate our available for sale. So beginning inventory. On the cost side, 35,000. I'm just picking this right up off the data that we know. And our retail side is 50,000 beginning inventory. Plus purchases pull that down. 19,120. On the retail side was 31,600. And then there's no freight in here, so that's actually makes it easy. But we got to now add on the retail side the markups minus the markdowns. Markups are 1,200, and the markdowns are minus 800. And this is the difference in the average cost method. We include both markups and markdowns. In the conventional retail method, we only include the markups for the cost of retail percentage. When you go calculate the ending inventory of retail, you still include both on the other method, the average cost method. So let's go calculate available for sale now. This is a matter of just math here. And I'm going to take 35,000 plus 19,120, and I get 54,120 at cost. And this is the same all, this is apples to apples, but this one's are the retail prices. And I add these down and I get 82,000. Yes, just check that. Now, hey, cost to retail percent equals 54,120 divided by 82,000. 54,120 divided by 82,000. Exactly 2/3, 66%. Now, off of actual data now, I'm going to go estimate what my ending inventory and my cost of goods sold is at cost. I'll be able to figure it out at retail. And so minus sales at retail, and the sales at retail were 32,000. And so ending inventory at retail equals 82,000 minus 32,000, 50,000. So now I've got all this data in front of me, and I think you can see it would be easy to calculate what ending inventory would be a cost. If the inventory we know about is 66%, the cost is 66% of the retail, then my ending inventory should also be 66%. So ending inventory at cost is going to equal 66% times 50,000 . What is that? 33,000. And now that I know ending inventory, I can calculate my cost of goods sold, which is 54,120 minus 33,000, 21,120. And there's your answer. So again, I will continue to stress that accounting takes practice. These problems take practice. And when you practice this, you will learn it. And when you learn it, I think it'll help you even on multiple choice questions. But if you get a problem like this that you've already practiced on an exam and you have done it, do it more than once, do it a bunch of times, and you get it down, and then on the exam comes piece of cake because you practice it, you know it. You even know how to lay things out on the piece of paper better because you've done that same problem. So with that, it is Friday where and I'm looking for a good Friday afternoon, although it's freezing cold here in the Dallas area. So I wish you guys the best and good luck on inventory accounting.